problem from your side. You go to the link given in the mail.
Sir, you are live now. It is for the participants to note that we had a technical glitch, so we have started 10 minutes late. We would have Niranjan Swain sir now on the webinar. Over to you for the webinar, sir. Thank you.
Okay. So any desk I will remove now.
Yes, sir.
You can disconnect.
Yes, sir.
And some more files are there. Just I'm disconnecting.
Okay, sir.
Online CP. I think it is not required also this file.
No, sir. Kindly let the files be. You just you disconnect from any desk, or we will do it from our side. If you hold,
Okay.
okay, you continue with the webinar, please.
Okay. How many participants are there? Just I will check out.
Sir, it is round about 250 participants now.
Okay. Thank you.
Thank you, sir.
Good afternoon to everybody. Actually, there is some technical issue, so we are starting little late. So today topic is very important for all of us, particularly those who are in the practice and those who are in the compliance side from the income tax compliance, those are looking after. And this topic which we are going to discuss is involved the provisions of Income Tax Act. At the same time, the cost audit report which is prepared by the company to whom the cost audit is applicable, as well as the cost auditors. And the third category is the ICDS compliances, which are very much required from 2016 onwards. And it is a combination of all the chapters. And then we have to cover the entire provisions to understand. And one very good thing is there some clarifications also issued by the institute very recently. And in the last, the few clarification also I will discuss, and the clarification particularly related to the practicing cost accountants while going for making the inventory audit valuation of the inventory as per the direction or as per the assignment given by the assessing officer. So what are the aspects which are conflicting with the different provisions, particularly the cost audit report, the tax audit report, ICDS provisions, and accounting standards, as well as the provisions of Income Tax Act under the amended provisions. So these has a few cases has been clarified. And you might have meantime gone to understand the guidance note issued by the institute, very nicely drafted. And mostly it requires a depth knowledge of all the aspects which I explained to you. So before starting, I will go step by step. Very much required that what are the provisions contained in the Income Tax Act. At the same time, what are the requirements we have to look into the other side of the tax audit under 34AB. And as a compliant to the provisions of a new provision, as well as the assignment given by the department. So that aspect also will discuss. ICDS also will be covered. And then we will go the reporting annexes, form 6D, which was now finalized, and the guidance note, as well as the few questions which have been answered and few case laws. Friends, before going forward, let us first take off what are the provisions contained in the Income Tax Act. Why the inventory valuation of the late means 1961 provisions when the new Income Tax Act was introduced, and after lapse of long time now the government thought of to assign this job to the cost accountants to make the inventory valuation. What is the impact of inventory valuation in the computation of taxable income? That is very important. So before going forward, you know that every assessee, generally inventory valuation will come in case of assessee those who are having the business profession income, particularly the business income, those are trading or manufacturing the goods and selling it. In the second case, the income from other sources, In both cases, the ICDS 2 is applicable, inventory is applicable. And in these two cases, actually, the valuation mostly required. So, in the first case, the assessee, as per the provisions of Income Tax Act, will ascertain what is the his taxable income. He himself will compute the business income, and then he has to find out what is the estimated taxable income, and on basis of estimated taxable income, he is going to, or the company is going to deposit the advance tax. And at the end of the year, after audit of the books of accounts, then they are ascertain the actual taxable income and any differential of the tax depositing and filing the return. In addition to number of compliances is required to be made, mostly the tax audit report. And the department usually never interferes in the previous year, and only few cases they may inquire about the payment of the advance taxes. And in the income tax provision, your guidance note also contains this all the details discussion in these provisions. So you are very much aware that as an assessee, you are required to file the return of income under section 139(1) by the due date of filing return. And if you are return of income also includes the return of loss. So, in case of a company, it is mandatory to file the return of income or return of loss. The advantages of filing return of loss is you can carry forward the loss and set up in the future years. If any assessee, particularly with the concern with the business assessee in the present context, those who are not filing the return within the due date, they are also required to file the return by the belated return by the date as prescribed. You know that in case of business assessee, those are covered under tax audit. They are required to file the tax audit report by the 30th September, and by 31st October, they are required to file the return of income. And in case of transfer pricing provision applicability, then it is extended by another month. That means by 31st October, they are required to file the tax audit report, and they are required to file their return by 30th November. And those are not covered under the tax audit. So individual HUF or other cases, they are required to file the return of income by the 31st July. If they could not file the return by the due dates, then they can file the return by 31st December, because your belated return filing date has been preponed by the amendment. So 31st December of the previous assessment year. So they are under section 139(4), they are required to file. The revised return, if you file the return of income and subsequently found any omission commission, then you can go for filing the revised return. And some cases, if the assessee could not file the return within the due date, then the department direct the assessee to file the return of income, and a notice can be sent under section 142(1). And you know that there is updated return also required to filed under 139(8)(a). And some cases when the return has been filed, but subsequently there is a discrepancy in the return, then the notice has been sent to the assessee as a defective return, and the assessee also required to make the correction of the defect, or if they are not accepting the whatever point has been raised, they are also required to file the resubmit it to the department. And in addition to that, under 148, when there is a reassessment, then the return of income has been filed. So under these circumstances, the next step is, once you file the return of normal returns, then it will go for processing. And under section 143(1), and while processing, generally the one intimation has been sent when there is some adjustments. And in addition to that, you before filing return, you are required to make the self-assessment, pay the differential tax, and your return has been first the summary assessment made without calling the assessee. That means it is nothing but a process of the return. Then the scrutiny return has been made under 143(3). If the assessee could not file the return, and in spite of issue of the notice under 142(2) or 148 could not file the return, then the self-assessment can be carried out. Or during the after filing the return, if the assessee is not responding to the department notice, they can also go for the base judgment assessment. And then the question of reassessment, recomputational assessment has been provided in certain circumstances. So now question is, These are the provisions which contain regarding the filing of return. And while you are filing the return, you are computing your income, particularly the business income, taking into consideration the provisions of section 28, which contains the income, and section 30 to 37, subject to section 40 and 43B, and some other sections, maintenance of accounts 44AA, and your 43, 44AB tax audit. So these are the compliances you are making and computing your taxable income. And particularly in case of manufacturing concern or trading concern, when the valuation has been made, the particular the inventory valuation has been made, and in that case, it has a larger impact in the profitability of the company. And you know that the profit of the company has been taken, or profit of the business associate has been taken for the recomputation or computation of the taxable income. The profit as per the statement of profit and loss account is not treated as a taxable income. So there are a number of adjustments are required to be made in compliance to the provisions of allowability of expenditure contained in the section 30 to 37 with a number of subsections. And in addition to that, these are subject to section 40 and 43B. 40 and 43B, these are restrictive sections with a number of subsections. So where even if the expenditure is a business expenditure, but it is still disallowed if certain compliances could not be made. So now question is when there is a undervaluation of a stock or overvaluation of stock, we see what happens, the opening stock plus purchase minus your sales is equal to closing stock. So now question is if the opening stock or your closing stock having undervaluation or overvaluation, it has impact in the profitability of the company. In addition to that, you might one thing you can remember, there are a number of methods has been adopted, maybe as per the AS accounting standard, Indian accounting standard, maybe ICDS. But if you are changing the method of inventory valuation, then it has an impact in the profitability of the company while computing the taxable income from business profession. So now what happens, the assessing officer, because the assessing officer is taking of scrutiny authority under section 143(3), and the assessing officer also taking of the best judgment assessment under 144, and the assessing officer also taking of assessment, reassessment or recomputation as per the new provision also 2021 onwards, that is your reassessment under 147. All the three places wherever the assessing officer found that there is a change in the method of evaluation of the inventory, there is undervaluation or overvaluation, or the method adopted is not in compliance to the ICDS, other cases. So definitely they are going to issue number of queries in addition to notices asking for submission of documents, and in that case it is practical not possible of the assessing officer to understand and go into deep to find out what is the difference, what are the non-compliances have been made. So that's why now what happens is in Finance Act 2023, a new section, that means a new subsection was introduced. Section 142(2)A was earlier also there. Subsequently, we can discuss about the maintain or the accounts, the department is suspicious about the maintenance of the accounts and the profitability, they can go for the special audit by a chartered accountant in practice. But there was no such scope for the cost accountants. But Finance Act, anyhow, Institute has taken a lot of steps for this introduction of this provision, made a lot of memorandums. Ultimately, Finance Act 2023 substituted with the 142(2)A. It is substituted in the sense the modification has been made. The earlier one provision was there for financial account for special audit. Now we can say it is a inventory special audit, we can say. And that's why the section has been amended, entirely amended to accommodate both the types of audit under special category. So now what happens? So from financial 2023 applicable from 23-24 previous year or assessment year 1st April 2024. So in that case, the AO can issue a direction for the valuation of inventory if he is of the opinion that it is necessary in the interest of the revenue. The reason already I explained to you why the AO can issue on a direction. And again, I'm telling the most of the cases do not have the power, so he has to go for approval from the principal chief commissioner of income tax or chief commissioner of income tax or principal commissioner of income tax or commissioner of income tax, depending upon the delegation and as well as depending upon the place who is heading the department. And the cost accountant is required to submit its report in the prescribed format. Friends, rule 14A has been amended and form 6D was introduced in addition to form C. It was for special audit of the accounts, and now it is 6D is for the inventory valuation. And 6D having number of there is an annexer, and the annexer contains a number of tables or the number of queries or questionnaires which has to be answered, and tables has to be filled up after due audit of the inventory. And a corresponding amendment also made in the subsequent sections, section 295, to empower CBD to make rules. So 295 has been amended to make the rules. Uh, uh, and exercising such power, the CBDT already modified, substituted 14A, 14B, and under section 142 2A. Rule 14A has been amended to provide the inventory valuation report of an assessee. Actually, it is prescribed the form 6D, and the form 6D draft was issued and now it is finalized. Similarly, 14P provides that the remuneration of the qualified cost accountant who is going for audit, and the rate, same rate has been prescribed, that it shall not be less than 3,750 and 7,500. And so one thing remember, you have to prepare a log sheet. What is the hour you are undertaking, and the different types of the cost accountants, qualified assistant, semi-qualified assistant, and other assistants. So detail has to be given. And a similar, the said rule has been amended to include the similar remuneration for cost accountants for conducting the inventory audit. Actually, now the both finance audit and cost audit, the remuneration has been prescribed, and the procedure has been laid down in the provisions. And already we discussed the 139 and 115 W2 provisions are there where return has been filed. And to some extent, this provision also already I have given some hints. I'm not repeating it here. And now question is, come to the basic theme of section 142 to A. So where you as a practicing cost accountant is deriving the power for going for the audit. So the AO at any stage of the proceeding before him feels it is necessary to do so. As already I told you, there is a complexity in the determination of the value of the inventory. And generally cost or market price, whichever is earlier. Sometimes we are net realizable value also we adopted. So these net realizable value, market value, cost price is not important because it is very easy to understand and get it. But a particular, again, the valuation of inventory is very important. What component to take and what component to not to take in. And the AO is it is not practically possible for the AO to go into do it, find out what is the cost is included in the inventory and what cost has been excluded or to be excludable under ICDS 2 but not excluded, and then what method has been adopted for the valuation, whether it is in violation of ICDS 2 or not. And then the question will come, what is the net realizable value? How to determine? We will discuss more on net realizable value. And similarly, what is the market price and what is the cost of conversion? How to determine the cost of conversion while you are going for the determination of the cost of a purchase or the cost of materials. So these are very complicated areas. It is very difficult on part of the AO to find out. So that's why if the AO feels that there is a nature and the complexity of the accounts of the assessee, volume of the accounts, doubt about the correctness of the accounts, multiplicity of a transaction in the accounts, especially in nature of a business activities. So in that case, they can go for with the approval of the competent authority, can go for assignment of this audit to a cost accountant. And actually, in case of financial audit, they can financial audit they can go for the chartered accountant, but for the inventory person they can go for the cost accountant. And another is when the AO shall not direct the assessee to get the account so audited or the inventory so valuable unless the assessee has been given a reasonable opportunity of doing that. Actually, what happens, you might have seen every whenever the computations subsequently will be discussed, the number of information has been provided in the ITR 6, particularly in case of company. Other than ITR 6, let you take those are filing the individuals or HOF, those are filing the ITR 3 with the computation of business income. Certain informations are required to be given in the form itself, right? Return of income form itself while filing the return. And in addition to that, your cost audit also report also contains certain tables which is also to be the information also required to give in. In addition to that, you might have seen why the assessing officer going for the scrutiny audit, generally ask for the cost audit reports. So if the AO is more intelligent, he can also go into deep and find out different data. Actually, in the practice, we also sometimes seen the cost audit report. They are also going into deep and searching the figures, particularly inventory and work in progress, scrap valuation of the scrap. But still, it is very difficult on their part to go into deep. So that's why they are preferring going for the this audit. So while the AO before the assignment of this audit, before getting the approval and in the process of approval and subsequently assigning this audit to the practicing chartered accountant, particularly in finance audit, same provisions are applicable to cost audit, cost accountants also in practice for inventory audit. So they have to give you opportunity to the assessee, then they can go. So without giving opportunity to hard, they cannot go for. And the report of the charter cost accountant in case of inventory audit, chartered accountant in case of finance audit, provisions are same. So who in turn will submit the report to the AO within a period which is prescribed. Actually, the AO has to decide what is the time period, and but it should not exceed more than 180 days. But practically difficulty has been found. You might have seen nowadays the Income Tax Act has been amended and preponed. The assessment date has been preponed. So why it is preponed? So because department wanted to make a complete of assessment as quick as possible. That is maybe the one of the intent is to refund flow at the same time also recover of the differential amount because of the reassessment. And that's why more time is not allowed. But in certain circumstances, if the sometimes the assessee may not allow the auditor to keep books of accounts with the interference of department they are giving. This is very important actually on part of a cost accountant when you going for inventory audit. Inventory audit is nothing but going to the heart to find out what is the what is in the deeper side the assessee in possession of different documents and on basis of which he has make evaluation of the inventories. Is there any manipulation has been made on that? It's very difficult to understand also sometimes on the part of the. And second, if the assessee is not allowing the auditor, it is also, I think it depends upon the personality of the practicing cost accountants to convince or to make a good relation to at least to access of the books of accounts. Otherwise, he may not in a position to audit it. He may subsequently come back to the department. So that's why the time period is very important because you have to give the in the same experience we have also in the excise audit under the provisions of Central Excise Act and during service tax period and excise period, pre-GST period we can say. So that's a maximum period is allowed 180 days, but usually the AO is giving very lesser period, 30 to 60 days to my understanding. So it is a top period for the all the packaging cost accountants if any assignment is made to them to complete the audit. So we should be very a coordinated relation we have to maintain with the assessing. The next step is the expenses. Already I explained to you. This has to be paid, and the cost accountant is required to maintain a time sheet, log sheet. Actually, institute has prescribed a log sheet in the guidance note. The guidance note, which is finalized and published. I think recently the final one perhaps uploaded somewhere in the Taxman blog. I was searching it. I found it. And the questionnaire also raised in the taxguru.com.in. Recently, the president has addressed, I think, institute address with 11 or 13 queries, which are very relevant. To some extent, we will also discuss. So that's a they have to maintain log sheet, and actually, the log sheet basis, the remuneration can be discharged, or we have to produce along with the bill to the department. So you shall give an opportunity to the assessee to submit his comments on the report. The moment the cost auditor will submit the his report with the comments in the prescribed formats and with the annexes, whatever additional is required. So it can be sent to the assessee, and the assessee can give its comments on that. If the assessee fails to comply with the direction of the AO to get the inventory valued by practicing cost accountant, the consequences are they can go for the AO can go for the base judgment assessment. And in my view, we see the one should not go for the base judgment assessment. Once the base judgment assessment has been taken off, means the number of informations maybe department capture and they go for once demanded means it is come to the dispute, and the dispute will continue for a number of years. So in addition to dispute, tax demand, interest, but that is also different penalty provisions are there. And the if the cost accountants are not been allowed or could not complete the audit, or the assessee could not cooperate to, then the penalty also to be imposed under 271. 271 penalty is very nominal, but there is implement provisions is there, and to my understanding, the implement provision is not so easily going to be implemented. So intent of our packaging member is not to that to get the extract of the work for and go forward with the submission of the report. The next one is a broad view. Just I wanted to give you generally what contains, but individual and detail wise also we'll go for discussion. And as a whole, just a broad view is the inventory valuation report of the cost accountants. It will generally it contains the detailed financial results, raw material for the year under reporting, details of quantitative details of the items, particularly in manufacturing concern, as well as the trading concern, the quantitative assessments, details of inventory valuation for the year. These are that actually this is the core part, and reporting by the cost accountants wherever ICDS is applicable, and evaluation of finished goods stock in trade, valuation of work in progress, raw materials, valuation of byproduct, valuation of intermediary product, valuation of other stores, summary inventory valuation for the reporting year. Whatever all valuations, a summary report has to be submitted by taking into all the details. And these are required valuation of finished stock to your valuation of other stores is required where the ICDS is applicable. But where the ICDS is not applicable, so in that case, the inventory valuation for the assessee engaged in the construction, sorry, wherever the ICDS is not applicable. So details of inventory valuation for the year reporting by the cost account will be given. So in some cases the ICDS is not applicable, but inventory valuation is a requirement, must requirement for all the business assessee. So in that case, the report also to be submitted, and the you can direct The A also can direct for inventory valuation in case of construction contracts, which is dealt generally ICDS 3, and where the valuation of a completed unit is ready for sale, valuation of construction work in progress, valuation of construction materials, valuation of construction fittings, similarly summary inventory valuation. So these are generally covered in this respect. The valuation of also is required to be made generally trading of securities, and generally you know that ICDS 80 covers the different provisions regarding the trading of securities, and particularly from the income tax reporting point of view, how it will be done. And valuation of shares held in stock in trade, valuation of a debt securities held as stock in trade, valuation of a convertible securities held as stock in trade, valuation of any other security held as stock in trade. So all the stock in trade valuation has to be made. I think our guidance report also very clearly explained in this respect, and there is a format also contains separately for construction contracts, separately for the security contracts. And then also all every cases there is a summary report has to be also to be prepared. So inventory valuation report, the livestock, agriculture, and forest products, mineral oil, ores and gases, except those held by the trader for such inventories. So in that case, also a detailed valuation is required. So valuation of inventory of livestock, agriculture, mineral oil, and particularly in this aspect, guidance has been given how to make the valuation. And a summary of a comparison, what will happen? The practicing cost accountant will go for the valuation, inventory valuation for each reporting. But at the same time, he will also going forward for referring to the 3CD format and the 3CD, the tax audit on the 44AB and value as per the cost accountants, both will be compared, because 3C, the tax audit report under 44AB also contains a number of para or clauses where reporting has to be made. I will overview some of the detailed discussion I will make what is there. Because as a packaging cost accountant, it will not only make the valuation, you will also verify the cost accounting records. You will also verify the tax audit report by the tax auditor. Then you see what is the valuation made there, the value of a closing stock, opening stock, purchases, closing stock, any changes in the method of valuation has been prescribed. The reporting has been made, quantitative details, and that should match with you. So if there is a difference, you have to give the reason of difference. So why the discrepancy? So that's it. That is very much required. So we will also cover some of the provisions of the tax audit report also. Then the question will come after making all the ready to the report, he will give his report. And just like your audit report, financial audit report, the reporting is segregated. And lastly, also I will discuss, if time permit, under each category how to report it. And a guidance note also given to some extent, whatever given in the guidance note, particularly how to draft the report. Report means after completion of everything, you have to give a report. Then there is an annexure of a different annexure with the details of information. So it is a part of annexure. So Form 6D annexure will give the details, but a certificate or we can say the audit report has to be provided you. So the first audit report covers yeah, the packaging cost accountant has examined the inventory of the assessee. So in that respect, you have to give it that yes, we have examined, or you have I have examined it, which is all provided. We have examined the books of accounts and other documents with respect to inventory, and inventory valuation of X or Y Z company, and with the permanent account number and for the assessment year. So under this, you have to give the details, what books of accounts you have examined. So hence, you know that 34AA contains maintenance of books of accounts. Your Companies Act also contains the maintenance of books of accounts. So you have to see that these books of accounts has to be covered. So my view is, in case of Companies Act, it contains details books of accounts has to maintain, whether it's a soft copy or hard copy. So even also Company Act allowed for maintenance of books of accounts on different accounting packages people are using, or floppy disk they are keeping as records. So now the number of ERP projects has been undertaken. So you have to keep what books of accounts, so cash book, bank book, ledger, journal, which mode it is maintained. So everything you have to give. So that's why the guidance notes also guides you with the details that. But prior to that, you also require to know what are the provisions related to the maintenance of books of account by the company. At the same time, also you are required to read the provisions of Section 44 double A along with the Rule 6F of the Income Tax Act to know what are the books of accounts are mandatorily required to be maintained by a business concern. And so that whatever books you covered, that also you have to mention there. And he has conducted inventory valuation in compliance with the requirements of the relevant provisions of Income Tax Act and income tax rules. And he has obtained all the information. These individual category details. And lastly, if time possible, I will also tell what to generally cover. But in the course of discussion regarding the table, I think almost all the information can be gathered by you by listening this. So now the third para has to contain that they have obtained all the information and explanation which to the best of his knowledge and belief were necessary for the purpose of inventory valuation. The next para also to be given in their opinion or his opinion, practicing cost accountant opinion, that proper books of accounts with respect to inventory have been kept by the head office and the branches of the assessee visited by him so far as appears from his examination of books of accounts, that proper data adequate for the purpose of inventory valuation have been received from branches not visited by him, subject to the comments given by him. Friends, particularly I'm talking about trading concerns or manufacturing concerns having different branch offices all over the India. It is not practically possible on the part of the practicing cost accountant to visit all the branches. So in that case, they are obtaining the informations in different so on certified mode or some other. So that has to be very clearly mentioned which where they got the information and which branches they not visited, but the information submitted has been relied upon. And and in their opinion, even if they are not visited, but they are of the opinion that books of accounts have been maintained with respect to the inventory and by the branch is adequate. So that aspect has to be seen. In his opinion and the best of his information according to explanation given by given to him by the company, the inventory valuation presented here below in his report is appropriate. Appropriate in the sense he is whatever his summary report is giving, it is nothing but summation of all the examinations and which is appropriate to his satisfaction and giving a correct view. So this is the reporting has to be made. And as already explained to you, before going for the reporting, it is very much required for the assessee to access to the provisions of the cost audit report. So first, quickly we can go forward. What are the disclosures or what are the reporting has been made in the tax audit report by the tax auditor? And this is clause 13 is not applicable to the inventory, but generally this is the one of the basic um, um, basic headings which one has to understand. That is, it is also applicable to the. It is not inventory reporting, but it is applicable to the inventory reporting. The method of accounting employed in the previous year. So it is actually financial information, but method of accounting in the sense it includes also what is the valuation you are following. So that's why while you are going forward, in the appropriate stage we will find it. So what is the method adopted? Whether first is accrual system or it is a cash system, but the valuation is to be made whether it is a your which price has been adopted, which method, your weighted average cost or people, what is the basis of valuation. So everything has to be seen, but you simply remember method of accounting employed in the previous year, whether there had been any change in the method of accounting, because what happens now, valuation method can be changed. When the valuation method will be changed, later previously adopting people, now you are adopting weighted average cost or vice versa. So what will happen? Because of people, the valuation of closing stock, which is the opening stock of the next year, is whatever is there. But once the method is changed, so definitely there is a change in the value. So whatever method you change, it has impact, positive impact or negative impact that is required to be reported. If the answer to the B above is affirmative, if the details of such change and whether any adjustment is required, already I told you. If the method of accounting you are changing, there is a positive or negative value with the impact in the profitability of the company. So that you have to, that has to be specified by the financial auditor. So this is not your reporting. This is the reporting which you have to report for the further reporting. Actually, if you go to the ITR 6, the form is the previous 2020 to 23, but the same format is continuing. Just to see part A where it is given debit to manufacturing account, opening inventory, opening stock of raw material, work in progress. Then your closing stock of raw material and work in progress. Cost of goods produced transferred to the trading, that is to be reported, and your total revenue from the operation case, you will find in the D, table D, closing stock of finished goods, total of crediting of the trading account, and opening of stock of finished goods, purchases. So these reportings are there. So it has a reporting, and then if you go to the part A, quantitative details. So there is also quantitative details data is there. And what happens in case of a trading concern, you have to give opening stock, purchase during the previous year, sales during the previous year, closing stock, shortage. These are to be given in the particularly while giving the information, these information is also to be required to be verified by the practicing cost accountant who has been assigned with the inventory audit. In the case of a manufacturing concern, opening stock, purchase during the previous year, consumption during the previous year, sales during the previous year, then closing stock, yield of finished products, percentage of yield, shortage excess if any. Actually, shortage excess or percentage of a finished product, these are very important information, particularly in cost audit cases also. If it is covered under cost audit, at the same time, the inventory, it has an impact in the inventory valuation. Another point why I'm talking about here, when you are talking about shortage or excess, which is abnormal shortage or a normal shortage. And you know that the normal shortage, as per the general accounting standard, it is included in the cost. So a standard is maintained, particularly in case of raw material, wherever there is a evaporation or there is a, by nature of the goods, there is a definitely there is a loss. So if it is normal loss, then it can be part of the cost. So that's why abnormal cost will be always excluded. So in the inventory valuation, when we are discussing, we can discuss, and you are very much aware about this fact also. Similarly, finished product opening stock of purchases during the year, quantity manufactured during the year, it will added to your stock, sales during the year, and closing stock. So these quantitative details has to be provided, and under the income tax reporting ITR 6 or other item where it is there. Particularly under 44AB, the method of evaluation, you see what happens. Already I told what is the method of valuation of closing stock. If there is a change And in case of deviation from the method, already I told you FIFO method to weighted average, or other than weighted average LIFO method or any other method. So whereas your ICDS is mostly concerned with the FIFO or weighted average method, so that's why the impact has to be specified here. Give the following particulars: a description of the capital asset which are converted to the stock in trade. Actually, generally, there are two new provisions prevails in the income tax. One of the new provisions which was new in the sense it was amended quite 5-6 years. Conversion of stock in trade in capital asset. There is a profitability impact, and similarly conversion of a capital asset into stock in trade. So the time we may not permit to discuss these things, but one has to see own capital asset has been converted to the stock in trade. Then after that it has been sold. So this has to be reported in the by the tax auditor. And similarly, trading concerns, relevant clauses, whatever in the 44AB, these have been specified in the 35, clause 35. So these are the has been specified. And similarly, cost regarding the cost audit report, your para 37 also contains of the tax audit report. You please verify the latest, because the modification has been made sometimes in the tax audit report formatting also. So you see, but the contents are still continuing. And whether cost audit was carried out, if you give the details, if any disqualification or disagreement of any matter, any item, any value, any quantity, as may be reported, identify the cost auditor, it has to be also reported here. So from these data, actually the assessing officer has to capture all the information, but still then he may not be in a position to capture it. That's why the assignment is going to given to the packaging cost management accountants, and the packaging cost accountant will take into consideration these reports, and also will report its reporting will be made in the prescribed format 6D. Then the method of valuation, these are the generally valuation has been made, all the items. The 14A, the details of the 14A format I have given in the 44AB, but these are the generally availability of the information. Raw material, work in progress, finished goods, consumables, maintenance of supplies, stock in trade, used tools. Used tool valuation is different from organization to organization. Generally, people make evaluation not adopting before method, only adopting the valuation they are making. What are the opening balance? What is the closing balance? Difference is the consumption. And actual value of inventory shall include purchase cost, expenses directly related to the purchase and duties. Friends, some discussion I'm making here. Few of the important discussion we can discuss in the ICDS also. Service cost, labor cost, and other cases. Simply remember, conversion cost we will discuss separately, because as per the inventory valuation, the cost of conversion of the inventory to bring the inventory to the present location and condition will be added. I am giving one example of the power industry, power generating companies, those who are procuring coal from the Coal India or different coal mines. So what is the cost? The cost not only includes the purchase cost, the cost also includes your taxes, duties, transportation, or if you have own MGR, merry-go-round railway system, or railway own railway line, so you are bringing it. It's a cost, also part of the cost of the coal, as per the valuation of the inventory, as per ASA or in the SA 2 also. ICDS also provides that. And you remember one thing I will tell to you, it is not only the purchase price paid to the supplier, taxes, duties paid to the supplier, but also if you are transporting through the railway, merry-go-round, own merry-go-round railway, the entire cost is a part of the cost of the coal. So what is the cost involved? The depreciation of the railway line, locomotives, then your manpower, those who are employed, consumables of the locomotives, insurance, spare parts consumed in the railway line, all are part of the coal as per the valuation. In addition to that, the conversion cost, friends, just very, it is not so easy. It is sometimes become difficult for the auditors also to ascertain the cost, and even also for the company itself has to make a separate policy for the inventory valuation. Particularly in this example I'm telling, so let the coal mine is 50 kilometers away. The power generating company is bringing the coal. So the coal cost includes the amount to pay to the supplier, including the taxes. Now, already I told you they are transporting through truck, so transportation charges, loading, unloading will be added. Let they are not bringing so the railway, vehicles, they are bringing it in the railway system. So all the depreciation cost of fuel expenses, manpower, insurance of the railway lines, everything will be proportionately calculated and it will be added to the coal cost. This is the landing cost. Then the question will become, coal is once landed, then it will be going to the grinding. So the big seat bolt side of coal is become the dust. And in the coal mill, some of the coals also remains with the coal mill. So how to make that? Now track later when the coal is coming in the MGR system, coal is unloaded. So that unloading place in on a track hopper. So in a track hopper, some coals has been remained. Then from track hopper by coal belt, it will go to the coal mill. So where the coal mill, the grinding will be made, and after that, the coal will be sent to the boiler. Then it will go to the boiler. It will fire, and then the steam will generate. So now question is, where is the inventory? Your some inventories are in the track hopper. It is in the coal set. Some inventories in the coal mill. That is also your closing stock. This is not consumed. So conversion cost is part of the coal cost. So you have to make a valuation. So when you are going for making the valuation, you have to make the valuation track of for the depreciation, the manpower cost, the other expenses. Similarly, coal mill is milling the coal, sending to the boiler. So also some stock remains. So now question is proportionate value of the stock remains of the expenditure will be part of the coal cost. So all the cost has to be taken into consideration to determine what is the inventory value. This is as per your accounting standard introduced to accounting standard 2, subsequently it become the INAS. The cost auditors also taking that cost and determine. It is not so easy unless you understand the provisions of ICDS, provisions of accounting standards, and provisions of when you are making reporting in the cost accounting standards, and then your inventory valuation reporting. So everything is a nothing but a combination of your all the experience you have to gather to report it. So now question is the actual cost of inventory, whatever calculation made, whether it is correctly made. So you have to require to examine it. The financial auditor, sorry, the tax auditor reported it. So that report you have to gather and you ascertain whether it is properly made or not. That's why in the some slides just before I told that form 3CD and your reporting any discrepancy, the region of discrepancy you have to give it. So you have to make a comparison of that, what they have taken, what you have taken, and whether there is a difference. I'm not talking about positive, negative. I'm talking difference. And if that difference, what is your comments? So that is very important. 44B, in case of deviation of the method of evaluation prescribed under section 145A. 145 is maintenance of generally the method of accounting and the its effect in the profit and loss has to be reported. And already I told if you opening stock, some last year closing stock is this year opening stock. Last year closing stock has been made evaluation on FIFO method. This year you adopted weighted average method. So in FIFO method of closing stock is converted to the weighted average of opening stock, because last closing stock, this is opening stock. So definitely there is a change in the value. So if there is a change in the value, what is the difference? So if that difference, what is the impact in the profit and loss? So that has to be reported by way of a calculation. The auditor to ensure that any deviation from the method of valuation prescribed under 135A is appropriately disclosed, and to the effect thereon on the profit and loss account is also indicated. And any taxes, duties says he actually paid or incurred on input should be added to the cost. So these are the input cost has to be given. Net realizable value, that is very important. What is net realizable value? That means the value of an asset that can be realized upon sale of asset, less reasonable estimate of the cost associated with the sale of asset. So inventory, when you are making, generally cost or market price, whichever is earlier. And sometimes the valuation method, you are also sometimes taking the net realizable. What is meaning of net? How to determine the net realizable value? And net realizable value determination is not so easy. It can fluctuate. It can be changed from one person to other, because sometimes it is very difficult to realize it. On net realization value, we will discuss some part in detail. Method of valuation of closing stock can be based on FIFO method, weighted average cost method, or specific identification method. But generally, ICDS is allowing two methods. And closing stock should be valued at actual cost or net realized value, whichever is earlier. And you know that the net realized value meaning is generally we found difficulty. If you go to the financial statement of most of the companies, most of the business associates, you will find inventory as certified by the management. So why this provision is there? It is very difficult to ascertain. Suppose I'm telling the closing stock, 1 unit is equal to 100 rupees. And this is the valuation made, and already we discussed valuation has to be made as per the standard or the valuation rule, whatever has been prescribed. But the same 100 rupees in the next day in the market, maybe 100, maybe less than 100, maybe more than 100. And sometimes, in particular in share case, security case, it can also fluctuate. So now question is, it is very difficult. Nobody will take the net realized value. And unless you realize the value, particular stock, you cannot set in net realized value. That's why most of the companies, while they are making the valuation of closing stock, they are they are giving a certificate. The valuation has been made as per this method. So nobody is taking in a financial statement the net realized value. Then if that is the case, so why this reporting has to be made? Now net realized, if subsequently it was found that the closing stock, whatever stock was there, it was realized at a very substantial less price, and then we can say the net realized value is less, that should be reported in the 31st March of the year. So if the auditor found that the closing stock value valuation made, but subsequently the asset is realized or the inventory realized at a substantial low value, then the auditor can give a comment. So it has to be seen by the both inventory valuation auditor. It should be ensured that the method of valuation of stock is appropriate and compliance with the principle of AS2 or Ind AS2. If the method of valuation is not appropriate, then a suitable qualification of the tax audit report is to be required in the 3CB. And section 145A, the same provision, it requires that you have to adopt a accounting policy. You have to comply with the accounting standards. If there is a change, then you can make a better presentation of financial statement. But whatever changes is there, that changes you are required to report. And it also makes some provision regarding the valuation, taxes, duties, sales, fee fee, etc., paid or incurred on inventory should be added to the inventory. If not already added in the financial statement of accounts, then the valuation has to be made by taking to that. So these are the generally 145A contains, and plus 35A giving a quantitative details already we discussed. So these are the quantity details: opening stock, purchases, sales, closing stock, shortages, excessive penny, how the shortages has been dealt, whether normal shortage or abnormal shortage. And already I told you, generally the accounting policy of the company talks about the normal shortage is part of the shortage. You are transporting the coal, transporting certain material, which you by evaporation or by moisture, there may be increase or decrease. So it has to be adjusted. If there is a normal, normally is based upon the standard. And every company have a policy, what is the standard. And if it is not as per the standard, as and when whatever they can do, it is not as per the compliance of the Companies Act or the compliance of the accounting standards. So that's why the auditor reported it. So you have to see the financial auditors reporting, and accordingly you can ascertain while making the valuation. And the reporting under this clause, the tax auditor is required to obtain certificate from the assessee in respect of principal items of the books. Very important. What is the principal item? You see, in many companies, there are number of items are there, and each item cannot be categorized. So that's the you have to tell what is the principal item. The goods traded, opening balance, general the principal. There is one clarification also given by the institute, but should be taken as a 20%. I think a criteria has been prescribed for the purpose. The details as per stock statement submitted to the bank ascertain the reason of a variation, if any. Hence, one point just I tell, even if the 35A talks about the stock statement and the reporting by the tax auditor, but in many cases we found the judiciary authorities are not accepting the this particular quantity which is given in the uh, stock statement given to the bank, because sometimes what happens now practically, I have gone through many of the cases also where it was found that the stock statement which is given by the company to the bank cannot be treated as a stock statement for the purpose of valuation. Generally, it can be given at an inflated cost. So the generally when the assessing officer found that it is an inflated cost, that cost they are taking into consideration. Accordingly, profit is redetermined and taxable income increased to that extent. So court has not accepted it actually. So that's a the stock statement though is given, but I have certain reservation on this particular point. The auditor should attend the physical stock verification conducted by the management if the inventories are material. So that's why they have to give a report, but nobody is going to do. And as an because the practicing cost accountant under the new provision, when they are going for the inventory valuation, they are making a post-mortem work actually, because that time the financial year ended, stock valuation, stock verification already made, the basis of stock verification. So there is no scope on your part to go and see it for that year, because this is assigned to you maybe after 1 or 2 years after after the financial year ends. So practically it's not possible on you. It is not required at all for you also, but if for the financial auditor can give a comments, because financial auditor is making tax audit subsequent to the end of the previous year. In case of in large concern, the tax auditor may verify the figures on a sample basis. So the principal item, as per the accounting standard, it is 10, but some clarification somewhere given 20% in the guidance note or somewhere. Please check up it. Somewhere I've written the slide also. Please check up it. So 10% of the aggregate value of the purchase or consumption turnover will be treated as. So whatever total purchases are there, what is the it's any item whose purchase is exceeding 10%, then we can say it is a principal item. And 35B also certain disclosures, which is a manufacturing concern. So we have the yield, etc. Already we have discussed. Similarly, finished product, some details also given. And 35B when the reporting has to be made by the tax auditor, because these data are very much helpful to you for the valuation. So where the assessee has not maintained any records for stock and has complied the information from the books of account, the fact from the same shall be disclosed. And where the assessee has not maintained the stock register, then the auditor shall qualify the report. And this, suppose the tax audit report qualified the report. So when the packaging cost accountant is going for the inventory valuation, so definitely he has to point out or report the same manner in his report also, because there is no difference in the reporting of the tax auditor or your valuation made by the cost accountants for the particularly any as per the order of the assignment of the assessing officer, because no stock record is maintained or not maintained properly. So they cannot it cannot be changed. And cross check of details of opening stock with the details of closing stock. I found category. I have one comment I am talking. Since I am practicing as an advocate, so mostly direct indirect taxes, I found many of our friends, those who are in the financial audit and opening balance, they are taking a different figure than the last year closing balance, and it is also audited. Audit report has been signed also. Many cases we found it, and even also assessment also completed. But sometimes the dispute raised, so when we are representing, going into deep, we found these are the differences. So that's why it is very your responsibility. Not only the quantitative details, you have to verify the closing items at the closing value. At the same time, you have to see that it is also same as in the opening with the opening value also. And you ascertain the figures as to purchase, sales during the year, and to the closing stock at the end of the year. The tax auditors shall obtain a schedule from the assessee indicating the opening stock, purchases during the year, sales. Generally, it is you can find it from the stock register. Tax audit shall obtain a copy of the stock statement given to the bankers. So these are the requirements under the manufacturing quantitative details also. Reporting has to be made in the same manner as the audit report. So we will not discuss more on this. Then there's a cost auditing reporting is there. ହଉଛି ପରେ କଥା ହେବି ପରେ କଥା ହେବି ଗୋଟେ ଅଛି business. So whether any cost audit was carried out, if yes, give the details. And the disqualification, disagreement on any matter, value quantity as may be reported, identified by the cost auditor. And the clause required disclosure of disqualification, disagreement. Actually, this has to be reported by your tax auditor regarding the cost audit report. And the cost audit report also taken as a base for your audit, inventory audit also, because certain data you can also take from there. So these are the generally reporting of the cost auditor. Generally, sometimes what happens, cost audit is not completed, but tax audit is completed. So in that case, the cost audit, the reporting also to be mentioned, the cost audit is not completed or report is not available. So that has to be given. And you know that cost audit report is not required to be uploaded, but whenever required, it has to be submitted to the assessing officer. So cost audit report also plays a very important role in this respect. So now question is, so the assessment actually at what point of time you required for the going forward for the inventory audit by the department. Now, generally, when the assessment undertaken by the assessing officer under 143.3, 143.3 is the scrutiny audit, or this scrutiny may be full scrutiny, limited scrutiny. Generally, now the scrutiny has been made, scrutiny assessment made for all the entire period with the entire coverage of the entire return. But sometimes specific item can be taken for the scrutiny assessment. So whether scrutiny assessment taken or undertaken under 143.3 for limited scrutiny or full scrutiny, entire scrutiny, but that time the assessing officer required you to give the assignment, and wherever the by such a seizure 132 or 132A, 133A, when the books of accounts has been called by the department and found that there is a escapement of income, or when the search has been conducted, but it was investigation made and found that there is a escapement of income, not reported the income, or the assessing officer by following the procedure as laid down under 148A and going forward for the reassessment or recomputation as per the new provision under 147 and issued the notice under 148. And then subsequently, after filing the return by the assessee, going forward for the recomputation or reassessment. So that time also they required for your help for the other giving the assignment for this audit. Assessee may be any person, the individual, HUF or the company or the association person, body of individual. So those who are having the income from business or those who are having income from other sources. Actually, the ICDS is applicable to the these two types of income, because share securities are valuation etc. may be required for the income from other sources. And central government may notify the time to ICDS, they have notified from time to time. And the assessee has to follow regularly the mercantile system, accounting cash system. Under income tax, there is no mandatory. You can adopt cash or you can adopt mercantile, but when you are going to change from cash to mercantile or mercantile to cash, then you have to give the impact of such changes, and either you are add to the income or exclude from the income, depending upon the circumstances of the case. And the business income is required to be computed as per ICDS. So that means the inventory valuation ICDS income computed disclosure standards has to be taken into consideration. And where AO is not satisfied, then they are going for the allotment of the this assignment to you. And the purpose of determining the income under the head profit and loss of a business profession, that is very important for valuation of inventory shall be made using lesser of the actual cost and net realized value computed in accordance with the ICDS. Valuation of purchase and sale of goods or services and of the inventory shall be adjusted to include taxes, duties, and other expenses what already we discussed it. Inventory in the form of securities not listed on a recognized stock exchange or listed but not quoted on a recognized stock exchange is required to be valued at the actual cost initially recognized. Inventory in the form of securities listed on a recognized stock exchange is required to be valued or at lesser of the actual cost and net realized value in accordance with the ICDS. So these have been described. These are the ICDS, they are 10 ICDS only notified. And out of that, in the inventory valuation, your ICDS 2, 3 construction contracts and ICDS 8 securities. These are very much relevant, and one has to go in details to understand the all the details. Now the question will come: inventory valuation report has to be given by the practicing cost accountant to whom the inventory valuation or the audit has been assigned under 142(2)(a, and in the form prescribed form 6D. Prescribed form 6D, in addition to certificate, there is an annexure is there, and a report of the A, which contain different types of certification. That is you have examined the books of accounts, you have conducted inventory valuation. A broad head I am talking. Availability, a format is given. On that format you have to go forward. Availability of all information, explanation already I have explained to some extent. Truthfulness and the correctness of inventory valuation, that you have to report. Truthfulness and correctness of annexes, means annexure whatever is given, reporting tables has been given, so all are correct. explanation for the variation in the reported inventory valuation and valuation are worked out, so that the reference has to be given, and the report to be already will not repeat it. Then we come to the annexure. Annexure is very important for you. 1 to 7 of the annexure contains the general information about the business methods of valuation of inventory. Important point to note that HSN or SSC code of a principal product services need to be provided for product services under inventory valuation. These are to be reported. Item number 8 is a table seeking financial information from the relevant assessment year and 2 years prior to that. So last 2 years and just a year called a cost audit report. Item number 9 contains different tables in respect of items manufactured, full quantity details of raw material, finished product, consolidated at an entity level, details of raw material for the relevant period, and the quantitative details in respect of items or traded or manufactured. Friends, one point I will tell, I will give a overview because item wise very difficult to discuss one by one, and a broad head to give some overview of the details within a very short period, having more coverage, have some idea about the details of inventory valuation requirement and reporting. That is the intent of this workshop. And when we are talking about decoding of section 142(2)(a), how best we can go to deep, find out what are the relevant surroundings which is required to be verified by the practicing cost accountant before going forward to deliver the output of the assignment given. So that is the intent. That's why we have the coverage of 3CD tax audit report. We have coverage of INDS 2 or ASA 2, ICDS 2, 3, and 8, cost audit report, provisions of the Companies Act, provisions of the Income Tax Act, then the inventory valuation prescribed in Annex 6D. So all the are to be, one has to go into deep. So 10, some of the tables I will discuss, but broader view, your item number 10.6, information about physical verification of inventory. 11 requires a declaration with regard to compliance of various your level of costing, purchase price, NRV in respect of finished goods, stock in trade, raw material. Item number 13 contains inventory valuation in respect of different items where the ICDS 2 is not applicable. So ICDS 2 is not applicable to livestock. Some of the items in the fourth category what we discussed, and a summary valuation additional information has to be given with the relevant comments. So if we will go to the annexure, these are the information, basic information. There is no such detail, more details required. This is the method of valuation is given item wise. So for the manufacturing cases, your finished product, stock in trade, work in progress, raw materials, byproducts, cost accounting standard. Generally, we have to follow. We have to verify it with the work in progress. Intermediate product, jig tools and dies, stores, spares, scrap, or any other item. So this is the method of valuation of opening and closing stock of inventory. This has to be reported. This is the financial information. Already we discussed in the point number 8. This is the financial information. Here you see one point: raw material consumed, opening inventory, closing inventory, average inventory holding period, average raw material stock to the consumption, average store spares stock to the consumption. So this is has to be given as per the audited accounts of the assessee, and details of raw material for the relevant period. And here inventory of all such raw materials that constitute top 80% of the total inventory value raw materials should be reported item wise. And we have seen their principal raw material. While determining, we are giving it as 10% or more of the value of the total raw material. So that will be treated as principal raw material. Number of row generally, because if you have a number of raw materials, then you have to add on the row in the table of the format. And shortage, wastage, and a rejection, etc. You have to also make the adjustments. And similarly, quantity details in respect of manufacturing concern, trading concern has to be given. Here you see the table. Actually, you have to go into deep the table format with the guidance note, where one by one you can make a comparison. And here has to be reported. It's just a quantitative manufacture during the relevant period, opening stock plus manufacture, quantity purchased, quantity sold, quantity rejected, quantity adjusted, or it is added or deducted, that is the reason, closing stock, and opening work in progress, closing work in progress. If the assessee, you have to report whether the assessee conducted physical verification of raw material, stores, finished product, and or the goods dealt is mentioned above, details of discrepancy. Friends, you say, or a manufacturing concern, or some spares are there where the it is voluminous spare, but the value is very less. So every year the valuation is not made. So that's then ICDS details inventory valuation reporting by the cost accountant. So wherever ICDS 2 is applicable, these are the information to be provided. Then the item level details shall be maintained by the assessee and the cost accountant, and the product produced if required by the assessing officer. Income computation disclosure standard 2 has to be given. Here we divided into 4 categories. Work in progress arises on construction contract. Work in progress which is dealt with other income computational disclosure standards. Shares, debentures, other financial instruments held as stock in trade, which is dealt by the income computation and disclosure standards. And the producers of inventory of livestock, agriculture, forest product, mineral oil, and gases, to the extent they are measured at a net realizable value. And again, I'm telling it's a very difficult task, particularly these items, livestock, agricultural, and forest products. And these are also not covered under ICDS 2 for the purpose. And details of inventory valuation, it is given cost of purchase or present value, net realizable value, the lower will be taken, the volume. So closing stock, so both has been given to make a comparison. And this is also valuation stock in trade, that is also given. Work in progress, the same table has been provided. It is also byproduct and other product. So all the details has to be provided by the cost auditors. Summary. So whatever information you have given, you have to take the abstract from this information to this table and provide the details. Again, the details of inventory valuation for the year under report, you will go for give the details about the disclosure standard 3. Disclosure standard 3 is equal to construction contracts. So construction contracts case work in progress. ready for sale completed units, particularly real estate cases, we can say also construction materials. Because when we are talking about valuation, so the valuation is for a construction contractor, uh, the valuation is the output which they are going to deliver. So that means completed construction units, then the work in progress, then the construction materials, then your construction fittings, supporting equipments, etc. And your reporting year for construction, summary of the inventory you have to provide, and details of inventory valuation made, that also the method you adopted that has to be provided under this table. This is actually the details ready for sale. You see, land is not part of the cost, particularly in case of real estate, because land is a capitalized. The entire cost will be treated as a cost. Valuation of construction work in progress. These are the table has been provided for the purpose. Construction material table has been provided. Here replacement rate is given to know the realized value. And valuation of construction fittings, supporting. So for each item, there is a table has been provided in the this format 6D. And your observation you have to mention here. The comments, observation, qualification, and all the things that you have to provide here. And then the details of inventory valuation. In case of disclosure standards, the valuation listed shares held in stock in trade, unlisted shares, debt securities, convertible securities held as stock in trade, valuation of any other security. So then the summary of inventory valuation. So this is your livestock. So there is a separate C table which is provided for the valuation of inventory, livestock, agriculture, forest produce, mineral oil, ore and gases, and then valuation submitted by the SEC, valuation as per the cost account and impact in the profit and loss account. So this has to be given. So you yourself have to find out what is the impact in the profit and loss account, because based upon that, the assessing officer will make addition to the income reported in the return of income, or they can modify the return of income while going for the assessment. And then these are the generally different formats has been given, and each item, what to refer, how to refer, the guidance. Why accountants have been chosen for the purpose of inventory valuation. The reason is the one of the reason when ICDS was made effective. So is and the ICDS mostly tried to keep it pace with the provisions of the that's why in the reporting the adopting in the accounting also. So the ICDS or the AS2, and then I am providing this slides, you can go into deep. It may not be possible on my part to cover. The other some of the questions we can cover in the which was clarified by the institute. So this is the already we covered. Here you see cost of inventory shall comprise of all cost of purchase. Already I explained to you all cost of services. That means which is services, transportation, loading, unloading. These are services. Cost of a conversion. Already I explained to you. Cost of services also includes the entire expenditure incurred to bring the I'm connecting. Hello. Yes, camera also, and I'm connecting also. I'm sharing, na? Just I'm doing it. The पता है actually auto, I don't know. Today some disturbance is there. Hello, hello.
Yes, sir. Yes, sir.
Actually आज थोड़ा प्रॉब्लम होता है इसमें.
Sir, kindly continue.
Just I'm continuing. Just I'm coming back. So that's why the conversion cost, one has to go into deep, find out the nature of industry, the manufacturing concern or trading concern, the nature, the details. Then the find out whether conversion cost which has been taken is as per the provisions of the ICDS or the INDSA. ICDS, INDSA, I think is the same. And the other cost incurred bringing the inventories to their present location and condition. So that's why I explained to you, particularly giving this coal example, when it was unloaded in the track hopper, so it is remain the coal. So it is brought to the location. Some of the coals remains there, but out of that, some of the coals again feeded to the mill. So when it feeded to the coal mill, the portion of the coal mill stock has to be valued separately. So there is a two portion of valuation. The coal which remains in the stockyard as such coal, the coal which is kept or unloaded but not lifted to the coal yard, that is in the track hopper, and the coal which is in the mill, in the working process, and it has not sent to the boiler. So definitely the valuation will be made at different stages. So stage of one is at coal hopper. Up to that cost will be taken. From coal hopper to coal yard, when you are taking, so some additional cost has to be included. So that is the valuation to be made. So in addition to that, some of the expenditure you incurred in the coal mill, that means depreciation of the coal mill, manpower employed in the coal mill, the power, fuel, and all such expenses overhead incurred at coal mill, and then you have to adopt a suitable method how to determine it. Every company are doing that, and then the quantity you have to take, how much quantity remains, that quantity will be valued in additional cost. So that's why the conversion cost and then bringing to the present location and condition. So first location is track hopper. Second location, some quantity remains with the yard. Third location, some quantity kept in the mill. So mill valuation will be different from the yard valuation, different from the coal hopper valuation. So that's why it is very important. That's why what happens now, most of the cost, most of the cases, if the valuation is undervalued or overvalued, it has an impact in the profitability of the company. At the same time, it has also profitability of the income and taxability. That's why the department is appointing the cost auditors, cost accountants to go into deep and find out. And these data are available, particularly in the industry where the cost audit is effective, so that these data can be easily available. But in case of industry or in case of a trading concern where the cost audit is not required, so in that case, then the practicing cost and management accountant, those who are appointed by the department, has to go into deep and find out. And the same already we discussed it, will not repeat it. This is actually the table which will give you details, basis of valuation, which is provided in the ICDS. This table I have taken from the ICDS, and you can go through it. Already we discussed many of the items. These are cost will not treated as a part, it will be excluded. storage cost, abnormal wastage, administrative overhead, selling distribution overhead, these are not part of the cost. Then cost of conversion, already I have given some example. These are the things we will not go for discussion because already we discussed, and few more items we can go for discussion. Cost of inventory, fast in fast out, weighted average cost. So both method are there. Most of the companies adopted the weighted average cost. So, but FIFO method is also applicable. So if you are changing the FIFO to weighted to FIFO, then you have to find out what is the impact that has to be reported. These we will not go for discussion. Rather, I will go for a few case laws. You see, in past, whenever the audit was not mandatory, so that time the valuation of inventory, a lot of comments also raised by the observation raised by the assessing officer, and it was disputed by the assessee, and then it has gone to the different higher forum. Few cases, just I'm telling. This case, the assessee had changed the method of evaluation of closing stock of finished goods and work in progress from net realizable value to lower of cost or net realizable value. This change had resulted in the increase in net profit. The assessing officer held that the assessee had been valuing the closing stock of finished goods work in progress at a net realizable value since last many years, and there appeared no reason to change the accounting policy except to reduce the taxable profit during the accounting year under consideration. This was the observation because of the change of method. So what is the decision of the judiciary authority? Accounting standard 2 issued by the ICI has been made mandatory in the case of companies. The accounting standard dealt with the valuation of inventory. As per clause 5 of the accounting standard 2, inventory should be valued lower of cost or net realizable value. Therefore, the assessee had no option but to value its closing stock of finished goods and work in progress at lower of cost or net realizable value. So net realizable lower, you see what happens. Now, valuation of a closing stock of finished goods and work in progress from net realizable value. So actually the changes is required as per the ICDS. So that's why the court hold that they are compliant to the provisions. In case of CIT Hindustan, there are number of cases are there. Just a few cases, just I have chosen. Supreme Court of India held that the method of valuation adopted by the taxpayer must be reasonable and consistently followed. So consistently follow is very important. The court also stated that the taxpayer is free to choose any reasonable method of valuation, provided it is consistently followed. But again, I'm telling this is the old decision. When the ICDS has not come out, consistently is the principle which has to be followed now also in future also. But the method should be as per the ICDS. Birla Cotton Corporation, there is one Supreme Court judgment where it was held that the valuation of closing stock must be on the basis of cost of the production or the market price, whichever is lower. The court also holds that the cost of production includes all direct indirect cost incurred bringing the goods to their present location. Present location condition is the key word used in the ICDS as well as in the SA. So it is paramount, very much important for our practicing member to see the location and condition. So which condition the material is there and which condition or which location it is now remained. So accordingly, the cost adjustment has to be made or expenditure adjustment has to be made. Scientific and rational basis. So this is the Supreme Court held that the valuation of closing stock must be done on a scientific and rational basis, and that the taxpayer must adopt a consistent method of valuation. Friends, one thing just I will tell, in many cases you will find 100% stock, physical stock verification is not made. Actually, practically also I'm talking. And they are adopting. So that's why that has to be also reported because it has impact because of the shortage, excess, abnormal shortage. These has been not taken into consideration. And here, rational, scientific and rational basis has given more importance. The Supreme Court held that taxpayer must adopt a consistent method of valuation and that the method adopted must be reasonable and based on scientific and rational basis. The court also stated that the method adopted by the taxpayer must be followed consistently. So you see, few case laws where consistently word has been used. The reason is if the moment you are changing it, so definitely it has impact either increase or decrease in value and which has an impact on the taxability. So that's why always the assessing officer, most of the cases we found when during the assessment they raise the query about the stock and they look forward that the stock there should not be any manipulation made in the value. So that's why they made a lot of reconciliation in this regard also. There is another case I'm telling. In course of assessment, the assessing officer passed an order that the assessee had changed the method of valuation of inventory, which has resulted in inventory being shown as a lower value. And what is the view of the court? On the revenue appeal, tribunal noted that the changes in the method of valuation was a result recommendation in consonance with the S2. When you see what happens when you changes the method because of the provisions of AS2 or ICDS2, then it cannot be commented by the assessing officer. But one thing, though it is not specified in this particular Supreme Court judgment, the impact has to be always reported because of such changes. And these are the few cases are there. Another is the Commission of Income Tax came to the conclusion that income tax officer ought to have valued the closing stock at its market rate. The contention of the assessee that valuing the closing stock at market rate value can arise only on a discontinuance of business, and as the business of the firm was never discontinued but was taken over by the succession. Here what happens, the case is the question raised whether it is mandatory to make a valuation of inventory at market value when there is a change in the constitution of the firm because of the death of the partner. So the issue is if the firm is not going to resolve, then the market price cannot be taken. Okay. So that's why the court hold that only in case of a discontinuance of business, then the valuation of the closing stock will be made at market price. Otherwise, the cost of market, whichever is lower, has to be taken into consideration for the purpose. So these are the few cases you can go through. And lastly, I will go forward. Since these, I think 13 queries has been answered by the institute. I think recently, only 3-4 days, I have seen in the tax guru. I have not gone to the site of the institute. Maybe it is uploaded. Just you can go through it. They have answered these queries. Out of that, some few queries I have chosen here, and let us also discuss before closing our discussion. First query was raised with regard to cost records to be verified. The query raised was there would be 4 scenarios. Already we discussed that while the inventory valuation made by the practicing cost accountants engaged by the department, they have to go forward to verify the cost records, because cost records is the base on which number of information data value you can also get, particularly valuation of work in progress, valuation of scrap, conversion cost. These are very, because cost center wise there may be allocation of cost also, so one can get it. So one situation is cost record mandated and not maintained. Second situation is cost record mandated and maintained, and the cost audit is not ordered. Third is the cost record mandated, not maintained, but cost audit ordered. Cost records not maintained, not mandated. So these are 4 situations. So question raised, as valuation is basically based on cost records, wherein the complication can come for scenario 1 and 4. In such scenario, should the records be prepared and cost statement prepared so as to evaluation efficiency of valuation of inventory? In all the above three scenario, complication is less, but only time provided may not be sufficient and may take a couple of months exercise rather than in 3 days. So generally, if a short period is there, so how to do it? The question has been raised. The reply has been given, clarification has been given that please refer to the section 145 and 145A of the Income Tax Act. Assessee has to maintain books of accounts in accordance with section 145, 135A and strictly follow the computation disclosure standard notified by the CBDT 10 accounting standard, which is notified. Cost audit and cost records are immaterial to the inventory valuation under section 142(2)A subsection 2. Then subsection 2 is for inventory audit. Subsection 1 is for the financial audit, special audit. Okay. Practicing cost accountants have to follow ICDS and may use the costing technique use, formulas, expertise to determine inventory value subject to uniformity with the ICDS. So ICDS is the most important point to go forward for the compliance. The second point is what will be the situation in case the client assessee delays submission of records. I was telling you many cases the assessee could not submit the report and department. So generally, a competent practicing practitioner can convince the assessee get the records, do it and complete it. Generally, it happens. So now this is a question raised. We may need to understand the whole process of a manufacture, but where the cost records are not mandated or mandated but not maintained, then cost records may be required to be prepared. In such a situation, should the profit and loss account be recasted or would just reconcile suffice the purpose? So the clarification has been given that practicing cost accountants has to check the records relevant to the inventory valuation only, and the same has been elaborated in the guidance note in the chapter 6. So 6 contains how to go for the inventory valuation. In case no relevant records, documents, and information are provided by the assessee, then it must be pointed out in the 60. We are not going to conduct a cost audit. Our scope is limited only to the inventory audit. We have to understand the manufacturing process to find out the valuation of work in progress, inventory pertinent to the nature of the company. So this is the clarification. The third is on the ICDS 2, the methodology mandated is inclusive methodology and not exclusive as being followed in the INDS. It includes taxes and duties recoverable in the form as input tax credit. However, the same is spoken about only purchases. However, for the purpose of a conversion towards valuation of work in progress or intermediaries or finished goods, ICDS 2 is silent. How do we deal with the same, especially when the composition of overhead has a valuation which is material in value, like for example, bought out services in the construction industry? So it is given that the faculty members has to follow only ICDS 2, clearly speaks on the cost of a purchase, cost of a service, cost of a conversion, and other cost. Cost of a work in progress or the intermediate product or finished product have to be derived accordingly. The fourth one is for the purpose of cost audit, interest cost would not be part of the cost of production. However, for the purpose of ICDS 2, on inventory valuation, interest cost should be inventorized. Actually, not in all cases. There is some specific cases. And the same is not being dealt with the guidance note. The condition of ICDX 10 is to be satisfied for inventorizing the interest cost. So the ICDX 2 prescribe that interest or other borrowing costs shall not be included in the cost of inventory. ICDS 9 deals with the borrowing cost and it is recognized for capitalization of qualifying assets. So that clarification has been given. Fifth one is In the guidance note, it was shown that the value of top 80% of the inventory is to be listed in the statement. Balance we should show it to others. Now there could be a situation wherein the value of inventory could be less as on the last day of the previous year. However, in the balance of 20%, there would be items which could have more consumption. So whether we will go with the value or go with the consumption. The reply is 60 prescribed reporting of other constituting 20% or less. So may do it accordingly. So here the percentage has been given importance, not the value. Query 6 is it required for cost accountant who got assignment to do 100% checking or to go for test checking? So actually it is the advice, it is replied that inventory valuation report, he should assure to extent possible that the same stands in the court of law. Maximum whatever. Santanu ଟିକେ ପରେ phone କରି କହୁଛି ତମକୁ ଟିକେ ହଁ ମୁଁ ଟିକେ phone କରି କହୁଛି ତମକୁ. So he should assure to the extent possible that the same stand in the court of law. So these are the queries has been answered. The 7 is the guidance note does not speak about the exclusion as provided in ICDS in regard to valuation of inventory such as abnormal amounts, wastage materials, labor, other production cost of storage cost, unless those costs are necessary in the production process prior to the further production stage. Administrative overhead that do not bring the inventory to their selling location. So this is very clearly mentioned. So that is they refer to chapter 4 and para number 4.7 of the guidance note and para point 4 number 7. What we discuss exactly regarding the normal, abnormal cost and certain exclusions, same has to be followed for the valuation. 8 is with regard to valuation of finished product. It was stated in ICDS that it should be valued with the cost of purchase or net realized value, whichever is earlier. However, what would be the last date that should be considered for the purpose of NRB? Friends, just for your kind information, reply also same. General, the net realized value is always taken in the 31st March. The reason is the financial statement is prepared for the year and reported on 31st March, and the entire the closing stock is 31st March. Income tax computation disclosure, whatever is there, that is on 31st March. So always it should be 31st March, not in between of the March. And 9 is in the case of intermediary product, it was stated in para 5.3.18 that packaging cost and management accountant should consider degree of its demand in the industries as an important factor to arrive at net realized value. Here there would be two questions that can be come up. One, the point that is being stated at 5.3.18 according to us supplies only for the purpose of classification of work in progress as work in progress or intermediary, where 100% of work in progress cannot be intermediary or work in progress vice versa. I am repeating again. The point that is being stated in para 5.3.18 according to us applies only for the purpose of classification of work in progress as work in progress or intermediary, where work in progress as work in progress or intermediary, and where 100% of work in progress cannot be intermediary or work in progress. So actually the sometimes what happens, the work in progress can be sold in the market, or the work in progress in a particular stage can also utilize for as an input to the other stage. Generally, it happens in the process industries. If such is the case, the para has to be given as a definition in the guidance note and should not be contained in the statement of a degree of the product demand in the industry. Two, one, let us also keep it to one, see the answer. In case where the company is selling intermediate, just I was telling to you, intermediaries product, we readily have a sell price. So in case where a company is not selling, but those intermediate product have a demand in the market, then we have to estimate the near value. So if the company itself selling, then that value will be taken. So if the company is not selling, consuming themselves, so then if that product is available in the market, then you have to take into consideration. So two also accordingly you can go through. Finally, we need to speak about independency of cost and management accountant practicing cost management, wherein can a cost accountant or auditor of a company take up the inventory valuation assignment under section 142A? Actually, if we go to the tax auditor, a financial auditor can be a tax auditor. So tax consultant, consultancy and a tax audit can be undertaken, but he cannot be internal auditor. Like this, a cost auditor can be a certified auditor appointed by the government, by the department. In case it cannot take up, then the criteria for the empanelment need to be amended so as to include more professional to be part of the empanelment. Friends, as I understand, because the AO only assign the job to the empaneled firms, they will not see the cost auditor or not cost auditor. So I think cost auditor can do it. And in line of the and friends, 11, 12 are very lengthy, could not be captured here. You can go through it. And how we consider the land value. Land value actually, you see what happens now. Land value in a joint development agreement pertaining to real estate project. So it is given that a real estate project value of land becomes the part of the cost of the building, flat in proportionate to the value. So flat as case, so land value is not inventory. It may be an investment or non-current. So this is given. And friends, one thing I will tell you, anyhow, this is the a chapter or the guidance note. If you go for discussion, it will take one day by item wise, and it is the assignment which is given, and it will take some time with this lot of modification by taking into consideration the practical facts. But one thing I will tell you from my experience, we have to see how many audits is going to be alerted by the department. We have, as a practitioner, in the service and subsequently as a practitioner, as an advocate, we found many cases, the department officers even also not getting time and how to complete, and they are taking up the assessment in the last stage and how to complete within the due date, because due date is very less, day by day it has reduced. So even also the provision of section 142 2A subsection 1 was in existence for a long period. Only few cases special audit has been appointed. And similarly, in this case, we have to see, anyhow, some cases it has already started, and department no doubt will get more benefit than special audit in case of valuation audit. Valuation audit uh, is a place where the valuation of inventory is a place where the manipulation can be taken by any associate. But we have to see how many assignment is government going to give it. Okay, so the time will tell it. And thanks to the institute for taking lot of pain, the council members, others, those who are involved in the process to develop the guidance note. Guidance note has captured many of the information and all the surrounding aspects, provisions of Income Tax Act, cost audit provisions, ICDS, INDS, and your Companies Act, and also cost audit, wherever, what are the related, all are captured there to give the overall view with a lot of experience to the persons those are going to do read it can have a very good knowledge. So I hope you can expect better from the department. And lastly, if we can close it, if you have any specific question, I will try to explain to you. You can also raise this question. Hello,
Yes, sir.
we can close or any.
Okay, sir.
And it took so much of time.
Thank you for your time, sir.
Okay, thank you.
We are ending the session, sir.
Okay.
যায় জানি আরো বেশি সময় লেগে গেল